S&P Global is a unique company that provides independent ratings, benchmarks, analytics and data for the financial and the commodity market. They are also provider of indices like the famous S&P 500. With 50 years of dividend growth, they are one of only 55 companies that qualify not only as dividend aristocrats, but even as dividend kings. And by the way, the term dividend aristocrats itself is a registered trademark of the S&P Financial Services. This unique position comes with a cost, and the valuation of the company is quite high. There also might be troubles on the horizon, as companies are currently much more careful when taking on debt in the current higher interest rates environment, and that could also impact the results of S&P. In this video, I will dig into the business models and the markets of S&P Global, analyze the strategic position by doing a Porter's 5 forces analysis, and have a look at the latest financial statements to see how they are doing. I'll also check the valuation and do a discounted cash flow calculation to determine the fair value. In the end, we will see if S&P Global is a good long-term investment for us or not. And guys, please excuse me if my voice today sounds a bit rough. My daughter brought home quite a bad cold from kindergarten and I am still recovering. But as always, my name is Florian and welcome to Cashflow Maniac. The ticker symbol of S&P Global is SPGI and they are listed at the New York Stock Exchange. They are working in the financial sector and were founded 1860. At the moment they have around 40,000 employees and their headquarters is in Manhattan, New York. Their market cap sits at $134 billion at the moment. First, let's compare the performance of S&P Global with that of their S&P 500 index. And here we can see that in the last year, the S&P 500 did outperform S&P Global by just a little bit, but this outperformance only came from the weak performance over the last couple of months. When we look at the 5 years, the trend looks different. Here we can see that S&P Global could outperform the S&P 500 by a bit more than 20% even. And over the last 10 years, it's even more clear. Here, S&P Global did deliver more than double the returns of the S&P 500. The business of S&P Global can be divided in 5 different divisions. First of all, we have the ratings division, where they provide credit ratings and financial data about other companies on the market so that their partners or banks or other institutes can make very easy decisions based on this data without digging into the financial details of each and every company by themselves. The second division is the Commodity Insights division, where they provide data and insights for the global energy and commodity market. The third division is the Mobility division, where they provide the same data and insights, but for the global automotive market. Fourth division is the S&P Dow Jones Indices division, where they provide index solutions across all kinds of different assets classes and all kinds of different markets to make investing easier for their customers. This also includes, for example, the very famous S&P 500 index. And last but not least, we have the Market Intelligence division, where they provide all kinds of different data and technology solutions for their customers so they can make very easy decisions based on these analysis and data that S&P provides. When we look at the revenue share, we can see that Market Intelligence division is actually the biggest share of S&P's business, followed by the Ratings division, Commodity Insights, Mobility, and last but not least, the Indices. Here we can also see that from the fourth quarter in 2022 to the fourth quarter in 2023, they had quite a nice growth over all of these divisions. So this is already quite a nice trend to see. Down here we can also see that they mention their Engineering Solutions division, but this is not included in the business divisions anymore because it was divested in January 2023, so around 1 year ago. As provider of these critical data and analytics, S&P Global has to strive always to be on top of the technology, to do the best research, to have the best data, and to bring this data to their customers in a way that is easy to understand and also easy to customize. So each of their customers can get exactly the data they need from these platforms. And here we have some examples of services and improvements that S&P Global brought to the market mostly in the last quarter of 2023. So for example, we have the Power Evaluator tool. That is an evaluation tool created to deliver deep insights into the true value of asset investments in the power sector. This is actually the first tool of its kind that allows its users to conduct custom valuations of existing and planned power plant assets and simulate the impact of plant acquisitions and divestments. Then we have the Platts Connect platform. That is a new web-based application that combines the company's benchmark data and insights in a single customizable interface, also for the energy and commodity market. Then we have some enhancements to the Capital IQ Pro platform, and most of these enhancements are in the direction of AI-enabled functionalities, search functionalities, and so on. We will hear a bit more about this later on. Then we have the Supplier Risk Indicator, which is a new indicator where companies can estimate the risks of their suppliers in a couple of different segments. For example, here we have the credit, the location, cybersecurity, and sustainability risks. Then we have a stablecoin stability assessment. And last but not least, we can see they also have introduced a couple of new bond indices directed at the Brazilian market. As I mentioned, these are only some examples that just happened very recently, mostly in the last quarter of 2023. So this already shows that S&P Global is very focused on always enhancing their tools and always bringing better platforms, better indicators to the customers to make more informed decisions. As many other companies also, S&P Global has been focusing very much on AI functionalities to improve their tools and to bring more value to their customers. Basically, to make the research and the analysis of their customers much easier based on these AI tools. And here we can see their strategy. They are not focusing only on third-party large language models, but they also have their proprietary tools. And for this, they already invested in Kenjo in 2018 actually. And here we can see a couple of their proprietary tools that they are already using. When we look at the Kenjo homepage, we find a bit more details about all of these tools. For example, Kenjo Scribe is a speech-to-text AI. Kenjo Nerd is a tool that enables smart searches and text filtering. Kenjo Classify makes it easier for the customers to develop their own concept models without any machine learning expertise. So here the customers can configure and customize their experience and their analysis in each of their tools. Kenjo Extract can extract data from PDF documents and can convert PDFs into a machine-readable format. Kenjo Link can combine all the data that a company has into one dedicated database without any duplications. Last but not least, Kenjo also provides datasets so other companies can train their language models. What I find most interesting about this is that S&P Global already acquired Kenjo in 2018, and that was quite a couple of years before the current AI hype broke out. And that shows me that S&P Global is a company that really looks ahead, that really has the ability to identify new trends even before the general market. In their annual report from 2023, they show quite a nice revenue growth over the last year. Here we can see divided by each division. And each of these divisions had some growth over the last years, even though the economy was not too strong and we definitely had some headwinds, especially in the ratings division. Not only could they grow the revenue, they only could increase their operating margins in almost all of these divisions except their mobility division. The mobility division of S&P Global is actually the newest division, and this was just founded after S&P Global acquired the company IHS Markit in 2022. So here some restructuring and some optimization is still going on. So I would expect that even in this mobility division, the margin should also stabilize or even increase over the next couple of years. Also, the decrease was only by 20 basis points, so this is a very low decrease. When we look at the Porter's 5 Forces analysis for S&P Global, first of all, I would estimate the threat of new entrants as low. There are quite high entry barriers to develop these sophisticated analytics tools and to bring together these huge databases with information that S&P Global already has. S&P Global also has a very good reputation in the market, which is very important, especially for the credit rating and indice business that they have. This, combined with a relationship that they have already with financial institutions and so on, make it very hard for other players to enter the segments of S&P Global. The threat of substitutes I would estimate as medium. As we just saw, S&P Global offers a whole range of different products, of different services. And while there are competitors for each individual division of S&P, it is very hard for any one player to replace S&P Global in all of these divisions. Also, the environment they are operating in is heavily regulated, and the trust that S&P Global already built with their customers makes it quite hard for other players to replace them. The competitive rivalry, on the other hand, I would estimate as medium to high. As we have just established, S&P Global has a whole different plethora of different services and platforms, so it is very hard for any one player to replace all of these services at once. But in each individual division and in each individual segment, we have other players, for example, like Moody's or Fitch for the rating services. And in these segments, there are usually only a couple of players that are very strong and that are very heavily competing for market share. And because these offerings are so similar, it is really the quality that differentiates each service from another. But the technological advancement is also quite quick, so each of these companies has to stay on their toes to not fall behind. The bargaining power of the customers I would estimate as medium. We just saw that there are a couple of competitors active in this market, and the heavy regulation in this financial industry makes it also very tough to differentiate your services from that of another company. Also, the customers of S&P Global are usually large financial institutes like banks or so, and they definitely have some bargaining power. On the other hand, the systems of S&P Global are integrated in the systems of their customers, and that makes it very tough to just easily switch them around. The bargaining power of their suppliers, on the other hand, I would estimate is quite low. S&P doesn't only rely on one company to get their data from, but they rely on a couple of different companies. And some of these information and data is even provided in a standard format. And that makes it very hard for their suppliers to bargain for better prices. As a major player in this industry, S&P Global also has long-term relationships with their suppliers. And that also gives them quite a good bargaining power. So overall, it looks like the strategic position of the company is quite strong in this market, and they definitely do have a moat, even though there are a couple of competitors that are also pushing very strongly to the same market and to the same services. If you do like the video so far, please smash the like button and consider subscribing to the channel. Thank you so much. When we look at the financials of the company, first of all, we can see a very nice top-line growth. Here we can see revenue on a year-over-year basis is increasing very nicely. We have a very nice uptrend here. And the same is mostly true for the bottom line, for the net income. Only in the last year we can see we have a slight dip in net income, but that can be attributed to the sinking margins we had over the last years. We already saw this in the last quarterly update. And here we can see it again. Operating margin did decrease a little bit. Net margin did also decrease. And the return of invested capital did also decrease by quite a bit, actually. The free cash flow, on the other hand, again shows a very nice uptrend here. Only in 2022 we have a slight dip here, but this can be attributed to the acquisition or the merger with IHS Markit that S&P Global did in 2022. When we jump to the balance sheet of S&P Global, we can see that the EBITDA also has a very nice stable uptrend over the years. The capex compared to the EBITDA and the revenue is actually very small, but last year it was a little bit increased compared to the years before. But this might also be attributed to the acquisition of IHS Markit. Here we can also see that the liabilities as well as the total shares outstanding here have increased with the merger. So S&P Global did finance this merger, first of all by issuing new shares, and second of all by taking on some new debt. But the current level of long-term debt, especially compared to the EBITDA, is still on a very good level. Also, when we look at the long-term trend of the total common shares outstanding, we can see that in general S&P Global is buying back shares. So usually The shares outstanding are decreasing on a year-over-year basis. Only in this case of a large merger, they did issue new shares. But in general, the financials of the company give a very nice picture, and especially the top line growth in the revenue and also the free cash flow growth point in a very nice, stable upwards direction. When we look at the analyst expectation and the forecast for the next year, first of all, we can see that the analyst expectation based on 24 analysts is pointing definitely upwards. So they give a very strong buy signal here. We can see the lowest of these analysts still expect a plus 2% increase in stock price over the next year, and the highest is even at plus 24%. The forecast for the earnings per share is also going up on a year-over-year basis, and the same is true for the revenue. So it seems like the trend is definitely still intact for S&P Global, and it can continue growing also over the next years. When we sum this up by using my checklist, we can see first of all revenue growth as just indicated, very nice upwards trend. Here we are sitting at a plus 15% CAGR over the last 5 years. The net income unfortunately was down this year a little bit, so this definitely also pushes the 5-year CAGR down a little bit, and here we are only sitting at a 6% CAGR over the last 5 years. Still not too bad, but a little bit below my 10% threshold. So it gets a yellow checkbox in this case. The free cash flow growth is very nice to see. Here we have a 23% increase over the last 5 years. So this is a very, very strong free cash flow growth, exactly what I like to see. The debt to EBITDA ratio currently sits at 2.8 times debt to EBITDA, long-term debt to EBITDA. So this is also almost at my threshold, but still a little bit below, so green checkbox for me. S&P Global is paying a dividend, but with a very small yield of only 0.85%. But the 5-year CAGR sits at 12.5% currently, and that even came down from 16% that they had last year. So the long-term dividend growth rate of S&P Global is very strong, and I would expect them also, with the amount of free cash flow growth they currently have, that they can also continue growing this dividend in the future. The margins and especially the return of invested capital did come down compared to the values we had over the last years, but we also saw in the last quarterly and annual report that the margins compared to the last years have increased already a little bit. So I think these pressure on the margins mostly came from the acquisition of IHS Markit and the restructuring of the company by integrating the new company, the new systems into their systems. So I would expect that the margins and the return of invested capital can again increase over the next years. Overall, unfortunately, we do have 2 yellow checkboxes here, but the health of the company and the growth trend of the company still seems very healthy and still seems very intact. Before I sum this up and come to my conclusion, let's have a look at the current valuation. And here we can already see that most of these multiples are sitting at quite a high value, especially when we compare it to the 5-year average. Here we have the time frame of 5 years, and here we have a EV to EBIT multiple of 32, PE gap multiple of 52, and a price to cash flow multiple of 36. All of these values are actually sitting above the 5-year average of S&P Global, and they are also quite a bit above their competitors. From a multiple point of view, S&P Global does seem to be quite highly valued at the moment. As a dividend payer, let's also have a look at the dividend yield. And here we can see that over the last 5 years again, the dividend yield was always fluctuating around this 0.80 percentage point. Right now we are a little bit above this, but in the past, especially in the time frame between 2022 and 2020, we were also sitting quite a bit below this, and it went even down to 0.6%. Indeed, it seems very rare that S&P Global trades above a dividend yield of 1%. So the current one seems about average. For my fair value calculation, I put in the current values into my model here. For the growth rate and the multiples, I use the 5-year averages here. For the share dilution, I put 0% here. even though the 5-year value actually sat at around 4%, but this mostly was due to the acquisition of IHS. In general, S&P Global is buying back shares, so I would actually assume on a long time frame that the share dilution is actually negative, and over a long time frame, S&P Global is buying back more shares than they are issuing. But still, we cannot say for certain, and that's why I assumed 0% here. With these assumptions, the fair value of S&P Global is actually very high. But I would not expect these very high growth rates especially to continue over the next couple of years. And in this case, especially for the free cash flow growth rate, I would rather assume a long-term value of around 10%. So let's use this for my calculation here. And I also use the margin of safety of 20% here. I'd rather be on the conservative side of my calculation. And with these values, we can see that the average fair value of S&P Global sits at around $450. And by including my margin of safety of 20%, we are sitting at $360. This is compared to the current stock price of $428. So when including the margin of safety, the stock seems to be a bit above the calculation. The unique combination of offerings of S&P Global combined with their brand recognition gives them a very good position in the market. In the rating section, they basically share the market with a couple of other players, and their indice business, even though it only makes up a smaller portion of the business, can very nicely benefit from the trend to passive investing over the next couple of years. The company is also heavily involved in integrating AI functionality into their products and in leveraging new technologies that can help them and their customers to easier find and analyze the right data. They also already identified the AI trend very early and acquired Kenjo back in 2018, which definitely shows their forward thinking. The financials look quite strong, and even though their margins and bottom line growth have slowed down a little bit since their acquisition of IHS Markit in 2022, but the integration is also well underway, and I would expect that S&P Global can benefit very nicely of these added services over the next coming years. So I am not overly worried about this hopefully temporary decline. Even though the dividend yield is not so high, the dividend growth rate is quite impressive, and with 50 years of dividend growth, the company could just enter the exclusive list of dividend kings last year. I believe S&P is a prime candidate for every dividend growth portfolio, and I am already invested in them. I'd also very much like to increase my position in them even further, but the only thing holding me back at the moment is the very rich valuation. But the fair value of the company, according to my calculation, is not very far below the current stock price, so I will keep dollar cost averaging in the company with every dip I get. As Warren Buffett said, it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. If you did find my analysis today helpful, and if you did like the video, please smash the like button and consider subscribing to the channel in order not to miss my next analysis. That being said, thank you so much for watching, guys, and see you next week.